So today I'm going to be talking about the Executive Retention Plus strategy, which is relatively new and something we put together, I don't know, maybe about 6 months ago to how do we help business owners? How do we talk to business owners? What, from starting those conversations is how you uncover how you can help. So that's where we started in pulling this together. So to get started, if you think about the average industry premium, usually I take guesses on this. The average industry premium on a life insurance policy is about $4,500. If you're thinking about the average advanced markets premium, think about what that number might be. Is it as high as 210,000? That's a big difference between doing a regular case versus doing an advanced markets case. And that's why at Midland, we put together this advanced markets team, and it's continuing to grow. 3 years ago, I think there was one attorney on the team. Now we have 6 individuals that are there to support you. So the team has grown very quickly. Why? Because we see the need in the market for advanced premiums cases. So in that vein, what we've done, and I'll just do a quick shout out to some resources that you have available because of your relationship with Mariam, because of your relationship with Michael. So what we've done is we've put together a business valuation service. If your business owner wants to get an idea of what the value of their business is, if they submit to us 3 years of their financial statements, we can get a business valuation run. And that business valuation is not just something that we're cobbling together. We've partnered with another company called Marshall & Stevens, which is a valuation company. This is what they do. They do business valuations and they charge a lot of money for doing business valuations. But because of your relationship here with us, we don't charge you anything for that business valuation. We cover the cost of that. Your client doesn't have to pay. You don't have to pay anything for that. Why do we do this? Because it gets the business owner thinking about, well, now that I know what the value of my business is, how do I transfer that business? How do I protect that business? That's the reason we do this. Of course, we want everybody to know what their business is worth, but we also want to make sure that the business owner understands where the holes are in their agreement or in their planning strategy. The other opportunity that you have by partnering with us is if you've got a business owner that has a buy-sell agreement. So 2 business owners, they put together a buy-sell agreement, how they're going to transfer their business. If you provide us that buy-sell agreement, we'll review that again, free of charge to you because of your relationship with us. We'll put together a document that says, here, Mr. or Mrs. Business Owner, here are the triggering events that are covered in your buy-sell agreement, but have you thought about disability? Have you thought about what happens if one of you becomes divorced? Because a lot of buy-sell agreements will cover death, but there's so many other triggers to think about. So by submitting that buy-sell agreement, it gives us an opportunity to have the conversation with you about how we can help this business owner think about where the holes are in that agreement. And then, of course, once you've got that agreement, one of the things that they need to be thinking about is, I've got this document. If something happens to my partner, for instance, I'm on the hook to buy them out. Do I have the life insurance available? Do I have the funding available to make that happen? And so with buy-sell agreements, they work very closely and very well with life insurance. So those are just a couple of pieces, a couple of things that we want to offer to you. Again, free of charge to your clients. So we understand business owners, that's what we want to focus on. And I'm going to share with you, and I'm certain none of this is going to be surprising to you. When you start talking to business owners, what are they concerned about? What are some of their goals? So a lot of them are thinking about what happens if a key employee that I have passes away, right? You hear that all the time. This person is my rainmaker. If they pass away, what happens to my business? Also, they're thinking about, how do I tie those key people to my business? I don't want them to go work for a competitor or become a competitor to me. How do I tie that employee to the business? What are some strategies I can offer to make sure that that employee stays with me for the long term? And then a lot of these business owners are also thinking about their own retirement. So, fast forward 15 years, I'm going to be ready to get out of this business. How do I make sure there's a buyer for my business? And how do I make sure that the buyer has the funds available to buy my business when I'm ready to leave? So, just a couple of things that I'm certain none of that is surprising to you, that this is priority one for business owners. So, with that in mind, we created this Executive Retention Plus to create a vehicle for conversations. How do you strengthen that loyalty for the employee? How do you hit on those long-term goals for the business owner? So that's what I've been invited to chat about here. And one of the things I'm super excited about this strategy. So Executive Retention Plus, strategy to achieve those multiple goals that I was just sharing with you. So let's start with the first thing. The business owner is thinking, if something happens to that key employee for my business, there's going to be a loss of revenue. The key rainmaker is not showing up. I need to hire a replacement. I need to protect the business from the loss of that value. What does that sound like? Key person protection, right? All day, every day, key person protection. It's a policy owned by the business, payable to the business on the life of that key employee. So the business is going to have liquidity, if access to that liquidity in that policy. If it's a cash value policy, the business is the owner. So that policy is an asset on the books of the business. But if something happens to that key employee, now they've got the money to hire a replacement, make up for lost revenue. Somebody shared with me the other day that they use this strategy to talk about, if I've got somebody I want to hire, a lot of people now want a hiring bonus. How do I attract that high level individual? I want to offer a hiring bonus to this person. Well, this key person protection is a great strategy. The business has access to that death benefit if the key employee passes away, to hire a replacement, pay that signing bonus to the new employee. So this is just protection that's owned by the business, and it's a life insurance policy. Can it be a term policy? Of course, all day, every day. Key person protection is oftentimes a term policy. But in this case, because you're going to try to address multiple needs, the conversation needs to be around cash value. And the benefit to cash value policies, of course, is you've got that access to that. The business has access to that asset throughout the life of that policy. That's important. So that's the first thing. You've got some key person protection that you're thinking about. The second thing, remember, we talked about we want to tie this employee to the business. So the business owner wants to make sure the employee stays. What if the business owner says to this key employee, if something happens to you and you pass away while you're working for me, I'm going to carve off a part of that death benefit in that key person policy, and I'm going to pay that to your family. So now the business is going to have part of that death benefit for all those reasons I mentioned, but then a portion of that death benefit will be paid to the employee's family. I think that's an important thing to offer to that key employee, because it shows them how much you care about them and their family. Yeah, Miriam.
Thank you. So a lot of business owners have on the key man policy. How is it tax treated on the premium if the business is owning it?
Yep. So the business owns the policy. The business is the beneficiary of that policy. The premiums are not going to be tax deductible, but the death benefit is tax free.
Got it.
So the death benefit, if the employee passes away, is a tax free death benefit.
Got it.
Which leads me to an excellent point that I think we can make about this next step is for that beneficiary. So for the family of the employee, we want to make sure that that death benefit is also going to be tax-free to them. That's important. And that's an accounting thing where the employee is charged a small amount. I call it like a rental fee for the right to receive that death benefit. So the employee, let's say we've got $1 million death benefit policy. The business is going to keep 600,000. If the employee passes away, 400,000 is going to be endorsed to their family. The employee is paying on the value of economic benefit for the right to receive that 400. That's a small term cost that he's going to have added to their income or bonus out to them to make sure that that whole 400,000 is tax-free to their family. I know that's a little bit maybe kind of deeper under the covers that we might want to go, but happy to talk more about that too.
And
But it is
who does-
important.
Yeah,
Yep.
who does this calculation? Like, if let's say I have a client and I'm implementing a key man policy with a split dollars endorsement. Who does the calculation on the portion that's going to the family, how much that is? And so basically what you're saying is that we're taking that portion and tax the employee.
We're taxing the employee, or we're adding it to their income oftentimes. So the employee doesn't usually pay that amount.
Yeah, it's like a
included in their
W-2.
income.
Yeah.
Yep, it's included in the income, and it's a small term cost for that 400,000 based on how much is endorsed, what the value is. We can help with that calculation. It's not a complicated calculation, but it's a small amount in order to protect that larger death benefit for that that employee's family. We can help with that calculation. It's the value of economic benefit calculation.
Got it. Thank you.
Yep. So that's the endorsement split dollar. That's the endorsement of that death benefit, a portion of that death benefit to the employee's family. There we go. And we chatted about this. So this is where the business is splitting that death benefit. But that only pays the family if the employee passes away. That's a good handcuff to keep the employee tied to the business. But what if we could offer something else? So the something else is saying to this key employee, hey, if you stay with me for the next 15 years, don't pass away, but are here at the end of that 15-year period, I will pay you a large bonus. Think about how much glue in the seat that creates for that key employee to stay with that business owner. So let's say if you pass away during the service period, your family gets part of the death benefit. But if you don't pass away, I'm still going to pay you a big bonus. So we call this the retention bonus. And it's the promise that the business makes to that key employee that they're going to get a benefit. How are you going to pay that benefit as a business owner? Yep.
So is that the cash accumulation that's in there?
That's one way to pay that bonus. Absolutely. So the way I think about it is all the business owners done is promised to pay a bonus. How can they pay that bonus? Well, they can write a check from the, books of the business. Or they can borrow from the cash value of this policy that's inside the business and use that money to pay the bonus and keep the policy in the business. Or they can transfer the policy over to the employee, because remember, it's a policy on the employee. So they might want that in year 15 or, whenever that end of that service period is. So they have options. And that's what I love about this is there's no, you don't want to promise the policy. You don't want to promise to transfer the policy. All you're promising is to pay a bonus. How the business owner wants to carry out that promise is up to them. But the policy is a great funding mechanism for that future obligation that they've just entered into. Did that answer the question?
Absolutely.
Hi, Paulina, it's Dane. I have a follow-up question.
Yeah. Hey, Dane.
Hi, how are you?
Good.
We did one for a a business that it was like his right-hand employee, and it was for his kids, the right-hand employee's kids' college. And so what the business is doing is they're like really overfunding. And at the end of, I think it was like about 15 years, by the time his two young kids would start going to college, the business is going to pull out its original premiums over those
Yep.
years, which I think was, I don't know, like 250,000. Would the business be able to pull out their principal tax free? And then when the business gifts the remaining policy to the employee, obviously that basis like drops way down. So all that growth essentially in there would be taxable to the employee. Would they have to pay taxes on that only if they take all those gains out, or could they continue to, or it would be a taxable event once it transfers to their, it's once it changes owners at that point, right?
So couple things there. So the business is the owner of the policy on the front. That's their policy.
Yeah.
Once they transfer the policy to the employee, if that's what they choose to do, any gain in the policy will be taxable to the business, not to the key employee, because they didn't own the policy. The policy is owned by the business. It's an asset of the business. If there's gain in that policy, the business is going to be taxed on that. The individual employee is going to be taxed on the value of what they received. So if the business first took some money out of that policy and the policy is transferred with a loan on that policy, or if they, if they withdrew, however they handled that, whatever is remaining in that policy, whatever the value of that policy is, that's what the employee is going to get taxed on.
But it wouldn't be, since the business already paid taxes on the premium amounts going in, let's say it's 250, and then they just do FIFO, first in, first out. So they pull their cost basis out 250, tax-free, non-taxable at that point, right?
Right.
And then let's say there's 200,000 in gains left in the policy, and they now give it to the employee. That 200,000 in gains becomes taxable to the employee at that point. Right?
Employer.
Well, now why would
because the employer, so think of it, any asset that if you own an asset with a basis of 100,000 and now it's worth 300,000, that gain in there is taxable to the owner of the asset.
Got it. So they would have to take the portion out to pay the taxes, then gift the remainder to the, okay.
Yep. I love that. So forgive me for splitting hairs. They're not gifting the policy to the employee. They're bonusing the policy to the employee. So the employee will be paying tax on the fact that they receive this large bonus. Or the company.
Isn't that double taxation?
So I was just going to get there. So you could promise 100,000 and then the employee's taxed on that full 100,000 so that, the value is lower, or they could promise 60,000, but bonus a policy worth 100,000 so that they're helping the employee pay the tax on that. So that's the double bonus situation.
And we did this a while ago, so it's starting to come back. A better way would be for the business to pay for college services and maybe even hire the kids a little at that point, right? That might be a more tax efficient way.
So anything that the business does on behalf of an employee, like if the business says, I'm going to pay for your kids' college, it will be still treated as a bonus to the employee, period. It just is going to flow through the employee to the kids anyway. But it's kind of the same situation. The business owner can say, I'm going to pay you a bonus of 100,000 I'm going to pay for your kids' college. It costs 100,000. The employee is going to get taxed on 100,000 because it's like any bonus that the employee receives. Or the business can say, I'm going to bonus you 60,000, but I'm going to give you something of value of 100,000. And now you can use that additional 40,000 to pay the tax on the 60,000.
So the best way, it sounds like, then, is to keep the policy in force. The business, to kind of avoid the double taxation, keep the policy in force and then gift the employee out the bonus dollars. So only through a loan, That way the policy stays in force, tax deferred, and then the employee pays taxes on the bonus. It sounds like that might be the
Yeah,
best way.
in my opinion, it's kind of half of one, whatever,
It's almost
however
like
you
it
say that
depends on who
expression.
needs what, I guess.
It depends on who needs what.
Yeah.
The employee is going to get income taxed on the value of what they receive,
Right.
whether it's a check or whether it's a life insurance cash value. But it just depends on where the business owner wants that policy to end up.
Got it.
Certainly to an employee, maybe, it's 15 years down the road, they're not quite as insurable in the future. Wouldn't that policy be worth a lot to them? And so
Yeah.
you've worked for me for 15 years. I know you, I know your spouse, I know your kids, your family. I want to protect you. I want to take care of you. Maybe I want to transfer that policy to you. But you don't have to. All you've done, the most important thing to think about with these retention bonuses is all you've done is you've promised the employee a bonus.
Yeah.
And then at that time, 15 years down the road, you have decisions to make. Do I transfer the policy? Do I not? The other thing I'm guessing somebody here is thinking, what if the value of this policy is more than the bonus that you promised, or it's less than the bonus you promised? The thing to keep in mind is you promised a number. You promised 100,000. If the policy is worth more and you transfer the policy, well, you've just made a bigger bonus contribution to your employee. If the policy is worth 70,000 at that point, you need to come up with another 30,000 somewhere else to fulfill that promise you made. So my suggestion with these, you don't have to do this, but I often suggest saying to this key employee, if you stick around for the next 15 years, I'm going to pay you a bonus. The amount of that bonus will be determined by the cash value in this policy on your life that I happen to have on my books. The reason I say this in such a flowery way is you don't want to promise the policy to the employee today, because once you've done that, you've created a funded deferred compensation plan, and then ERISA comes in and it becomes complicated. But you could certainly say, I promise to pay you a bonus 15 years down the road, and the amount of that bonus is measured by the life insurance cash value. The life insurance is just a measuring stick. And so then 15 years down the road, you look at what the cash value is, you could transfer the policy or you can write a check, and the tax consequences are the same. The value to the employee obviously is different. Is that helpful?
I like that a lot. Thank you. Yes, let's go.
Awesome. Okay, perfect. So we've talked about this bonus. And again, you can see what I'm trying to show here is so far we've built everything on this one cash value policy. You don't need multiple policies to accomplish all these goals. That's the cool thing about the strategy. So now fast forward 15 years, or in the business owner's mind, they're thinking they're going to retire at some point, right? Let's say that point is 15 years down the road. You've tied your employee down for 15 years. They're going to stick with you. You've handed them a big bucket of money in year 15, which might align with when the business owner is looking to get out. So now your employee has the money to buy into the business if they're your succession plan. This is not a requirement. It's just a nice option. So for this business owner, they've had this employee with them for the last 15 years. The employee knows ins and outs of this business. The business owner wants them to be their succession plan. You've handed your successor a bucket of money about the time you're looking to retire. If that's not, for some business owners, they say, my kid's going to take over my business. It's not going to be this key employee. No problem. You've handed a retirement plan to your key employee. That's cool. But if your employee is your succession plan, you've given them the funds to buy into the business. Any questions kind of on that next benefit of this plan? Makes sense? So
Yes.
it's either a retirement plan for the employee or it's maybe a vehicle to buy into the business. So they would have to have a buy-sell agreement that they set up that says, you know, you're my succession plan. You're going to buy my business when I retire. The other thing they can do, and this is not anywhere on the screen, so now you're getting a little bit of a bonus conversation here. The other thing the business owner can do is say, look, if I, the business owner, pass away between now and 15 years from now, the buy-sell agreement will allow this key employee to buy the business, right? My spouse isn't going to be in my business. My kids aren't going to be in my business. This key employee is my successor. So they could set up a buy-sell agreement today that says if the business owner passes away, the employee is going to buy the business. How is the employee going to have the money to buy the business from the business owner when the business owner passes away? Shockingly, the answer to that is life insurance. Not this policy that we're talking about right now, because remember, this policy is on the key employee. Now we're talking about a separate policy if that's how they want to structure it. Now it's a policy on the owner that the key employee is going to own. And if the business owner passes away, the employee has to use that money to buy the business from the deceased business owner's family. What do you think about that twist? So
That's an awesome one.
Different, right? So
Yeah.
we've protected the business from the loss of the key employee. We've tied the employee down by promising to protect their family if they pass away. We've tied the employee to the business because if they leave within the 15 years, they get nothing and like it. And we've given them the money to buy into the business in 15 years because of a buy-sell agreement. That's what we're talking about today. But I gave you this extra little bonus conversation of a one-way buy-sell agreement with a life insurance policy on the business owner that could pay for the employee to buy into the business if the business owner passes away during the service period.
And how would you structure that, Paulina? Are you saying that the key employee, since that buy-sell is on the owner, the death benefit, does the key employee pay a portion of those premiums to then buy them out and give the money to the family and then own the business? Or who's the payers of that buy-sell?
Yeah, love that question. Love that question. So that's not what this is, right? Everything that we've talked about so far is a little bit of a different animal. This is now, you're kind of taking me down a different road, which I love talking about. What you're talking about is a one-way buy-sell agreement. So the employee and the business owner go into an agreement that says if the business owner passes away, the employee has to buy the business. The employee now is going to have a life insurance policy on the business owner. The employee is the owner and the employee is the beneficiary. Business owner passes away. The death benefit comes tax-free to the employee. And what happens at that point? The buy-sell agreement kicks in. And the buy-sell agreement requires the key employee to buy the business, pay the money to the employee's estate, their family, and now the employee is going to become the owner of the business.
And that agreement forces that employee to buy the business at that time. They're obligated to do that. And then I guess there can be different ways, like a wait and see what the business is worth at that time, or a set valuation or matrix, or business valuation.
Yep, a good buy-sell agreement is going to outline how you're going to determine the value of that business. But a good plan is only going to work if on an annual or a biannual basis, they value the business to make sure that there's enough life insurance in that the employee has to make sure that when that business owner passes away, there's enough money in the employee's hands.
Would they,
Oh.
at that point, would they just go to Midland to ask them to increase the death benefit and get re-underwritten, or do they have to just get, 5 policies, let's say over the course of 15 years, like, an additional maybe 3 policies, a new policy every 5 years kind of thing?
I will defer to my friend Micah.
Yeah, Mike, have you done one of those?
So, and that's a really smart question because generally businesses grow over time. The need for the benefit grows over time. And so we like to get, even if you can't afford as the business to fund this the way you would want to from the beginning, we love putting these together with large tag along term policies and using some sort of insurability like income replacement or estate preservation to justify the need for that coverage. And as things change and they do their business valuations periodically, you can convert that term into the plan that Pauline is talking about.
And the other thing that you can do too is in that buy-sell agreement, if all of a sudden you realize that I know it's going to shock everybody on this call, business owners don't review the valuation of their business every year like they should. If all of a sudden the business owner passes away and the employee doesn't have enough death benefit to buy the full business, well, then what happens is the buy-sell agreement provides some terms of buyout. So they're going to say, you're going to use the death benefit as a down payment, and then the rest of it is going to be paid over the next 5 years or the next 10 years or whatever it is. It's an option. It's not as great of an option for the dead business owner's family, because now they're standing to receive those payments over time, and what happens if the employee defaults and whatever. It's just not as clean as having the right amount of death benefit available, but it's a backup plan. And those are a good buy-sell agreement is going to have a backup plan. But yeah, to Micah's point, you could start with a policy and then convert and have part of it be term, and then you can convert as you go because it's important to have the amount of that death benefit. So I know I've kind of gone a little bit astray. I hope Miriam's not too upset with me, but it's a really good kind of other side of the coin on this whole plan. But to kind of pivot back to the executive retention conversation, this is what we've got so far. Is we've got our buy-sell funding. Maybe we'll start at the bottom. We've got key person protection. We've got this endorsement to the family. We've got the retention bonus, and we've got funding for the buy-sell agreement, all on one cash value policy. That is not to say that any of these things are not good standalone conversations. So key person protection all day, every day. We talk about that. Retention bonuses, we talk about that all the time. It's just this particular strategy kind of pulls them all together into one life insurance policy conversation. I've got a case study. I've got a case example. Happy to do that. Otherwise, if you want to, I can open up just the floor for conversations.
I think a case study would be great. One thing about me, I'm a very simple person. I would like to know what to say, how to talk to my business owner to start the conversation, because I know I have your backing and Micah's backing. I don't need to be the brain behind it. I just need to, learn how to start the right conversations, right?
Okay, how about this? So you're in front of a business owner. What are things that they're thinking about? I'm concerned. What are the things they're going to say to you? I'm concerned about the value of my business if my employee passes away. I'm concerned about the employee leaving. I'm concerned about how I'm going to pass this business when I'm ready to retire. I think that's going to resonate.
How my key employees even going to buy my business? How are they going to have enough money?
Exactly. Yep, exactly. And your key employee is thinking about, do I want to stay here for the long term? What are my other options out there in the world? I've wanted to own my own business forever and ever. I don't know how I'm going to be able to do that. I don't have enough money to do that. And they're worried about their own family. How do I protect my family if something happens to me? Right? So Miriam, this is an easy conversation with those business owners because this will resonate with them.
One thing you also said about divorce, that's a conversation I don't think I've ever had. Yeah.
Yeah. A divorce conversation is really important to business owners because especially if they have multiple owners. Because if you and I own a business together and I get divorced, the divorce court could take my half of the business and split it in half and give half to my ex-husband, and I keep half of it. So now you and I are in business with my ex-husband. Probably not awesome, right? So having a buy-sell agreement that says if one of us goes through a divorce, the divorcing business owner has the first right to buy that half of the business from their ex-spouse. And the ex-spouse, or not the ex-spouse, when we're married, the spouse is gonna sign the buy-sell agreement saying, yes, I know that if we go through a divorce, you're gonna buy out my interest. So it's not that they get nothing, because they're gonna get the money. They're just not gonna get the business. So it's a good buy-sell agreement should have death, disability, retirement, divorce, just separation from service. I'm just done working, I want to leave. All of those, bankruptcy is another one. If a business owner goes through bankruptcy, you don't want the business to go through bankruptcy with them. So having any of these, I call them triggering events, any of those triggering events would allow the purchase of the business interest without it getting messy. That's a good buy-sell agreement. And if you remember in the beginning of this conversation, I said we can review buy-sell agreements. That's the kind of stuff I'm looking for. Do they have those triggering events? Are they appropriate? And is the funding where it needs to be? Because a lot of times, again, another big sidetrack, but I've reviewed, if I tell you I've probably reviewed 200 or 300 buy-sell agreements, I wouldn't be exaggerating. I know what I'm looking for. And a lot of times you'll have a buy-sell agreement that'll say, if one of the business owners passes away, the other business owner has to buy their interest. And then what they do is they buy a life insurance policy, but it's not owned by this other business owner that has the obligation. It's owned by the business. So you've got the money in the wrong place. All of that is things that I review when I look at a buy-sell agreement. Is the money in the right place? Do you have life insurance? How do you determine the value of the business? And are all the triggering events covered? And I'm happy if you want to do another call at some point where I can talk in depth about buy-sell agreements, can do that as well. So far, here's what we've got. We've got a business owner that's got needs, and we've got the employee that's got needs. So let's say what he's going to do is he's going to buy a life insurance policy, and it's going to be a cash value policy on Tammy for $1 million, right? Straight up key person protection, owned by the business, payable to the business. Then he's going to say, if you pass away, Tammy, your family is going to receive $400,000. The business is going to retain $600,000. That's that endorsement split dollar. So now Tammy's family is protected if she passes away. But if she doesn't pass away, this retention bonus agreement is going to kick in. And what they've done is they've said, if you stay with me for the next 15 years, you will receive $400,000 bonus. And remember, he doesn't have to transfer the policy. He could just write a check for $400,000 if she stayed with him. So once she's completed that 15-year period, she's going to get a big bonus. By the way, that bonus, when it's paid from the business, I didn't mention this, but it's deductible to the business. If it's taxable to her, it's deductible to the business. Like any bonus, right? If your company pays you a bonus, the company takes a deduction, the individual includes that in compensation. This is the same thing. So the business gets a large deduction, she takes that into income, there's a way to do that double bonus, Dane, that you were kind of mentioning earlier, to make it painless for her for that, to pay that tax on it. So that we can structure around that as well. But now she's got that money, and the buy-sell agreement is going to say that she's going to buy into his business. And now you've put the money in her hands in order to make that, probably not the whole business, but to put the down payment for the purchase of that business when he's ready to retire. And that's kind of the important thing here is this is all done with one policy.